This is Top Down with TCM. I'm your host, Weston Weinberg, joined by Azaan Barlas and Jason Cruz. And today we are speaking with Tanner Larson. Tanner, thanks for joining us today on the program. And can you tell the viewers a little bit about yourself?
Yeah, so my name is Tanner Larson. I'm one of the portfolio managers of the TCM equity portfolio, as well as an analyst for the financials, utilities, and REIT sector. I'm in my last semester here at Cal State Fullerton. Had a pretty good time so far, and I look forward to talking with you all tonight.
Nice.
Cool. So yeah,
so who's going first?
I'll ask a question first. So we're all analysts in different sectors, and we know that you're part of a team of 3 that covers financials. Can you tell us a little bit about what you found interesting in financials and what you've learned after joining TCM about like your sector?
Yeah, so we cover financials, utilities, and REITs, and they're super interesting. They're pretty unique as far as valuations go. For instance, financials have an entirely different balance sheet where assets are almost treated like liabilities and things are kind of flipped on their heads. So there's definitely a learning curve trying to figure out at first how to read them. And then on the modeling side of things, we can't use DCF models because the assets are, like I said, assets aren't treated the same. So we have to use DDM models or dividend discount models, and then flow to equity models. You can even do, comp models as well. It's just it was different, going into the class, learning to use DCFs and then being told as soon as I got my sector, don't use DCFs. It's been a lot of fun learning. Yeah. And they're interest rate sensitives. So interest rates have a huge effect on all 3 of those sectors.
Can you explain how interest rates have an effect on those sectors?
Yeah. So financials, it's pretty straightforward. They take people's money and lend it out. They have to pay, an interest rate on the money they have from their consumers, and they make money from lending it out. So the yield curve is super important to financials. They pay on the short end and they collect on the long end. So that difference, that spread, it's called a net interest margin. That's where the vast majority of financials profit comes from. Utilities, they're susceptible to interest rates because they're typically dividend paying stocks. They're almost like bonds, which you guys are very familiar with. So when the interest rate goes up, the yield the price goes down to, so the yield can go up. That's how it works there. And then real estate is subject to borrowing costs. So interest rates play a huge role there. In people's mortgages and real estate loans, in commercial spaces as well. So they're really susceptible to changes in the interest rates.
Interesting. I'm learning so much right now.
Tanner's going off with the vocabulary.
Oh no.
So I want to talk about rates. Lately, I think this past week and then a little bit of last week, rates, the 10-year treasury has kind of shot up. It's now at I think 150 basis points, 1.5% around there.
Across that threshold.
What's that? What that is doing is it's destroying tech stocks. The NASDAQ is dropping hard.
Yeah.
And so the question begs is this the end for momentum? Because when the pandemic kind of started, or kind of into the pandemic, momentum stocks have been going crazy. Tech stocks have been going insane. So is that dead in your opinion?
I mean, that's the big question of the month. I think maybe what's happening more than momentum dying is maybe you're getting kind of a gut check that, valuation still does matter a little bit. So what you're seeing is people kind of taking a look at their portfolio and realizing, hey, maybe these companies that were valued at, crazy multiples, maybe that did work when there was free money basically. And, things were kind of running a little rampant, but maybe that's not going to work now. That basically as the interest rate goes up, it's going to get harder to borrow. And your opportunity cost is now a little bit higher. Whereas before, if a bond, if the 10 years paying, less than, 0.7%, of course you're going to go into equities. But now that the 10 years paying, 1.5, maybe the 10 years looking a little more attractive, and you're willing to kind of forego the crazy risk, have something a little more stable. But I think momentum in some regards will stick around. Maybe we'll see some companies fall out here, but I think momentum's here to stay, at least for, a little while.
Mm-hmm.
Yeah.
I would agree with that too. I kind of want to ask again on financials and those sectors that you talked about that are affected by the interest rate. Since the momentum, like tech stocks right now, aren't doing so well, what do you feel about financials moving forward, especially with interest going up? Do you think interest will keep going up and financials will keep doing better? Like, how would you position your portfolio with financials?
Definitely, yeah. So interest rates financials were, they weren't doing too hot, especially during 2020. And even, ever since 2008, 2009, they've kind of haven't seen the run-ups that a lot of other companies have seen. But ever since, this year started and these interest rates have started to increase, financials have had a great run. In January alone, or year to date, including January and February, I think financials ran up. The whole sector was up 12%. Whereas the S&P was, I want to say, flat, if not down. So they were a great place to be at the beginning of the year. And I think they will be still a great place to be moving forward. Especially if the interest rates do keep rising. There's talk that the Federal Reserve may kind of step in and do some work on the yield curve. If that does happen, then that's just another headwind. But right now, with the yield curve like it is, that's good for financials, and that will continue to be good for financials moving forward.
Okay. So, real quick, I have a question. Do you think, because you just said financials perform well when interest rates increase, right? Do you think that's already been priced in, the fact that rates can only go up from here? Or do you think there's still opportunity there for people to get in?
Yeah, so they benefit from the curve, the spread between the short end of the interest rates and the long end of the interest rates. If that spread continues to widen, definitely they're going to be doing better than they are now. I think you can make an argument that what currently has already happened has been priced in. Like I said, they've had a great run in 2021. But if this continues to happen moving forward, and I think another point that I would love to bring up too is that, the 10-year being at 1.5 is still incredibly low. It might not happen anytime soon. I mean, over the near term in a period of 1 to 2 years, but eventually the 10-year most likely will recover to say, 3% was fairly normal even 10 years ago. If that happens again, then, you could see great valuations on these companies and higher profit margins.
Mm-hmm. Cool. I guess I'm going to kind of take a step back and kind of talk about REITs. Now, I don't know much about them, but I do know that real estate is in a different position now than it was for the past couple of years. And I just kind of want to know, what's your opinion on REITs? Yeah, so REITs are structured. I'm not sure if you know about how they're structured. Very interestingly, they can't make their profits capped. Basically, REITs are not allowed to make more than X amount of profit. They have to pay it out to shareholders. That's why their dividends are so high. They do a lot of reinvestment into the company, so it's it's a pretty good setup as far as investments go. But the retail space, and I'm sure you're alluding to it, it's been flipped on its head, especially with COVID. Malls are shut down, retail locations across the country are shut down. People are working from home, so that's affected the commercial retail space. And then
who's to say how long this is going to last? Are companies really going to be paying, X amount for office space moving forward? That's hard to say. So I think you're going to see some pretty interesting changes moving forward. In our sector, we're trying to look towards what we almost call stable REITs, things like data center management, things kind of more on the technology side of things. And that's where we see the real opportunity for growth. They are trading pretty high valuations, so it's kind of a hunt to figure it out. Yeah. But it's going to be a shift here and, moving forward of what worked and then what will work. And you're going to have to figure that out for yourself.
And with like pricing the commercial property going down, it almost becomes a question of where's the opportunity in the REIT sector. An interesting thought that I had, and I was wondering if you shared the same, was on industrial REITs. Because with companies like Amazon needing warehouse storage, that's not going to go away. You're able to move along the lines with the boom in the tech and the online marketplace and e-commerce trade. Do you have any take on if that's a good opportunity for the TCM portfolio to move towards those industrial REITs, or are you seeing more opportunity in a different subsector?
Yeah, I think that's a great point. Less traditional is probably going to be what works moving forward. Simon Property Group is the company that I've written about and covered frequently. One of the things, so they're a mall owner, but one of the things they've done is they've shifted space. They started opening apartments in some of their malls. They partnered with Lifetime Fitness and they brought gym space into their malls. There was talk of them working with Amazon to renovate mall space into distribution centers. So I would agree with you there. That kind of paradigm shift is going to be important moving forward. You're going to have to find that kind of, tricks that work. What hasn't worked what's worked in the past probably won't work moving forward.
Mm-hmm. I kind of want to, this conversation is like super interesting. Just want to mention that real quick. Even though technology is super overvalued, you kind of still said you're looking for properties or REITs that still deal with technology. And that kind of makes me think a lot of tech companies have been overvalued, but I'm curious what you think on companies like PayPal and Square that are like financials, but also tech companies. Like, do you see them like dropping in value like heavily or like dropping in stock price, or like, I just kind of want to know your opinion on that.
Yeah, I mean, it's hard to say. But a company like Square, every store I go into, at least every small store has that Square tablet and you pay on. Yeah. And I don't see that, decreasing moving forward. Those companies have found a niche space and I think they're going to occupy it and they're going to be successful there. PayPal has, off the top of my head, they have Venmo, which has been incredibly successful and probably will continue to be successful moving forward. They do have, a touch stretched valuations, but that's the question, are those valuations going to continue moving forward? Yeah. But I don't see there is a space for companies like Square and PayPal moving forward, and I think they will continue to be successful and find growth.
I don't know if you look into the valuations of those companies, but again, in your opinion, do you think they make sense where they're trading at right now?
Yeah, I don't know.
Just not close to reality.
Right. Me and Ryan have talked about it. So off the top of my head, I don't know the valuations exactly well. But PayPal is, it's way high. I don't know what exactly investors are pricing in or what I don't know what they're seeing that I'm not seeing, but those valuations perhaps are a bit stretched. Maybe there's something that PayPal is yet to realize that we'll see moving forward. But personally, I don't see that matrix.
Okay, cool.
Now, one of the big reports that you sent up to the board and got approved was the Ali financial report, and it's Ali's performed very well since you sent it up. Can you tell us a little bit about what you liked about it, what the different revenue drivers were, And is this a stock that's worth holding on to for the next or through the end of the summer?
Yeah. I liked Ally a lot. I wrote the report. Honestly, I think I wrote it when the stock was trading low 30s, and it's currently sitting around 42, 43, that range. So it's definitely had a run up. And the thing I liked about it was investors seem to be wary of the fact that they primarily do auto loans, which is seen as something that's a little riskier. And then on top of that, they do auto loans to lower credit customers. So they operate kind of a high risk credit space, and that kind of threw people off. But if you look at it, the government was giving, each individual a check, every U.S. citizen. The unemployment added money every week for the unemployment benefits. They added that additional safety net to almost where the point where people were going to pay their bills. There was little chance of them defaulting, and I saw that and said, if they're occupying this high risk credit space and people are still going to pay their bills, they're going to be incredibly successful. And they set aside huge loan loss reserves, and they didn't realize too much of it. In fact, they were able to roll a lot of those loan loss reserves back into the revenue. And they were successful, as you can see, and investors realized that. Moving forward, where they're going to stand, that's hard to say. I would still hold them. They might realize some more efficiencies, and then there's talk of them moving out of the auto loan space and a little bit more into the mortgage space, which is going to be huge moving forward. Home prices across the country have been peaking a little bit as of late. So it's a good space to occupy there, and they seem to have very good management. So I do like the stock, and I'm interested to see where they're going to go from here.
Just to add, it was like one of the most fire reports I read, just because the formatting was super good. So I just wanted to say that.
Thank you.
I guess we don't want to keep you for too much longer, but one of my last question would be, I know that last semester you were an analyst, but now you're actually on the equity team now, and you're a lead PM for the equity team. I kind of want to know, how has that been? And do you feel like you've grown as a person or anything, being a PM? Just how do you like the experience?
Yeah, definitely. Being an analyst is, completely different from being a PM, especially a lead PM. I was an assistant PM on that President Scholar team last year. So I was used to writing a little bit of the reports, but being a lead PM, it's you got to figure it out. The pressure's on you to make moves and to kind of understand the market. So in analysts, you write the reports, you send them in, and you're like, all right, let's see if they accept them. But being the lead PM, you see the reports, you're like, all right, what are we going to go through with? Are we going to buy this, sell that? So it's definitely a little bit more work, a little bit more pressure. That being said, though, I do like it. I like seeing, being able to manage where we kind of put the portfolio, how we position it going forward, and you get to really make those decisions and be included in conversations that are very high level, something that you really don't see too much as an analyst.
That's a cool take on that. I guess when me and Weston were in the equity team last semester as well, it wasn't we weren't lead PMs, but it was just rough. Having to look at people's reports, and we're literally overweight by so much, we can't approve this, and we just have to sorry dude, we can't approve your report. And they put so much work into it, and it's just kind of rough, the human aspect, I guess.
Yeah, definitely. You gotta look through and make decisions, and it's tough, so knowing one of your fellow colleagues spent countless hours writing that report to just be like, oh, sorry, it's not going to work out, But it is, it's part of the job, part of the role.
True, preparing us for real life, I guess.
Yeah.
Well, this is real life with Juan. I actually do have one last question, since I don't want to keep you on. We spoke with Ryan, your partner on the TCM equity portfolio a few months ago. He was actually the first person that we interviewed for the podcast.
Right.
And what I'm wondering is, how are you guys looking to reposition the equity portfolio, like in terms of like asset classes and asset allocation, before the summer starts, or before the end of the next 2 quarters, or are you looking to maintain the positions that we currently have?
Definitely. We actually talked about this the other day. The last year's team did an excellent job, picking the allocation for the portfolio. They really set us up for success. And as you can tell, the portfolio had a great year. 2020, it returned something like in excess of, I think it was close to 700 basis points of the S&P 500. So it was a great year in 2020 for TCM portfolio, and we really thank the last year's class for that.
You're welcome. Continue.
Moving forward, it's what are we looking forward to? We are trying to, change a few weights and things. The financials weight we're trying to get up. One thing we are focused on is we kind of want to ensure that all the positions in our portfolio are the best positions in that sector. Say we have a company like, for instance, PayPal. We looked at PayPal. Is that the best holding that we can have moving forward? Or is there a better holding that we can have to take its place that, PayPal's had a great run. Maybe its run is over. What's the next PayPal? Can we sell PayPal and put another great position in there that will benefit next year's class? And that's been a lot of our focus, is just making sure we got the best positions and the best in each sector.
So it's keeping a similar like asset allocation strategy as before, but with a little bit of an increase in financials due to the interest rate increase or whatever factors your analyst team is looking at, and then while also trimming some of the laggards in the portfolio, and then increasing position sizes of the very best companies that are attributed to the portfolio. Is that correct?
Yeah, I'd even add, instead of trimming the laggards, maybe even trimming some of the leaders, taking our gains, realizing those gains and trying to find the next leaders. That's where a lot of our discussions have been centered around.
Great. And Jason, do you have any last question to ask?
No, Tanner's free. I'm good. I'm good. I would like to say though, Tanner, you were one smooth talking analyst. I'll tell you that.
Damn good.
Thank you.